Ladies and gentlemen, yield curve inversion is almost universally accepted as one of the best leading indicators of an upcoming recession and the stock market crash, which typically accompanies a recession. And that's why we must be very, very cautious at this stage because of this massive inversion that we got in the yield curve in the very recent past. And personally, for me, the most troubling part of the recent yield curve inversion that we got is the fact that this is only the fourth time in recorded history that we have got yield curve inversion lasting more than 500 days. And guess what? The first three times the yield curve inverted for more than 500 days, the outcome for both the economy as well as equity markets was nothing short of a disaster. The first time we got a yield curve inversion lasting more than 500 days was back in 1929, which was, of course, followed by the Great Depression and the Dow Jones crashing by almost 90%. The next time this happened was in 1973, following which the S&P 500 crashed by almost 50%. And finally, we got the third instance of a yield curve inversion lasting more than 500 days between 2006 and 2007, in the aftermath of which we got the global financial crisis of 2008 and the accompanying crash in the S&P of more than 50%. So is it the same fate that awaits the US economy and equity markets in 2026? Well, that's exactly what I discuss in this video, so please do watch this video till the end. Ladies and gentlemen, hi. A very warm welcome to all of you. I want to start by wishing each and every one of you, my dear viewers and everyone in your families, a very happy Diwali, and I sincerely hope that all of you have a very joyous and a prosperous year ahead. My dear friends, as we ring in Diwali, equity markets here in India are finally starting to show signs that are all set to join the equity market party that has been on in global equity markets since April of 2025. The Nifty closed last week at a new 52-week high, and the Nifty is now less than 2% from its most recent all-time high of September 2024. Now, for those of you who have been following me on my channel, none of this should come as a surprise, because I have long been arguing that equity markets are likely to witness a ferocious rally as Federal Reserve's rate cut cycle gains pace. And guess what? That's exactly what's been happening in global equity markets, especially in the US, where all the leading indices are now at new all-time highs. This rally has, of course, been a little muted here in India because of the overhang of an unprecedented 50% tariff that has been imposed by Donald Trump's administration on imports from India. But my dear friends, equity markets here in India also are starting to sense over the last 1 week or so that this stalemate of sorts that we are witnessing with respect to the tariff situation is unlikely to last for a very long time, and that we are likely to see some kind of a resolution to this situation sooner rather than later. And my dear friends, this realization is unmistakably helping to set the stage for an equity market rally to gain pace from here in India as well. But my dear friends, as we prepare to ride this rally that is finally starting to take shape, we also need to ask ourselves as to how long this rally is likely to last and what are the factors which can finally bring this rally to an end. And that's because only if we are able to answer this question will we be able to initiate timely interventions with respect to exiting the equity markets before this ongoing rally starts to lose steam and pave the way for the next big equity market drawdown. Now, this is something that I've explained in many of my previous videos, and that is the rally that we are witnessing in equity markets around the world is basically the last part of the melt-up that has historically almost always been witnessed in equity markets between the points when the Federal Reserve starts to cut Fed funds rate and the point when the US economy finally slips into a recession. So if you are looking for markers for when this ongoing equity market rally can potentially come to an end, you have to basically look for markers on when the US economy can potentially slip into a recession next. And in this context, I want to go back to this earlier video of mine, which I had published more than 1.5 years back on 6th of April 2024. This is one of the most important videos that I have published till date and continues to be one of the most watched videos that I've published since I started this channel. And if you haven't seen this video, I'll strongly urge you to go and have a look at this video. I'm going to leave a link to this video in the description. So what is it that I had discussed in this video? Well, in this video, I had laid down three prerequisite conditions that must be fulfilled before a recession in US can start to materialize. And what were these three conditions? Let's check them out. The first condition was that the yield curve should have uninverted. The second condition was that the balance in the reverse repo facility should have gone down to 0. And the third condition was that the Fed should have started to cut Fed funds rate. My dear friends, I continue to receive comments even till date asking me to take stock of where we stand with respect to these three conditions having been met. And now that the last leg of the equity market melt-up seems to have finally kicked off, I think it's a very good time for us to go back and check as to where do we stand with respect to these three conditions being met. So let's do that. Let's start with the first one. Yield curve should have uninverted. But what exactly is the yield curve? And what does the yield curve uninverting even mean? Well, to understand what is the yield curve, we need to first understand what are government bonds. Well, government bonds are basically the instrument through which governments borrow. Well, think about it this way. If you and I have to borrow, we basically go to a bank and we take out a loan. But that's not how governments borrow. If governments have to borrow, they basically issue what are called government bonds. And anybody can invest in those government bonds. If you are investing in a government bond, you are essentially giving a loan to the government. And when it comes to US government bonds, they come in various durations. There are US government bonds of duration as short as 1 month, and then there are US government bonds of duration as long as 30 years. If you invest in a US government 1 month bond, you have essentially given a loan to the US government for a duration of 1 month. And if you invest in a US government 10-year bond, then you have essentially given a loan to the US government for a duration of 10 years. And when you invest in a US government bond, the US government is going to pay you an annual interest. Now, the annual interest that you can earn by investing in a US government bond, which is also called the yield of the bond, is determined through a market-driven exercise. If there is excessive demand for US government bonds, which basically means that a lot of investors want to invest in US government bonds, under such conditions, US government does not have to offer a very high interest rate in order to attract investors. Therefore, the yield on US government bonds starts to trend downwards when there is excessive demand for US government bonds. Conversely, when demand for US government bonds is not very high, under such circumstances, US government has to offer a higher annual interest, a higher yield to bond investors in order to attract investors. Therefore, the yield on US government bonds starts to trend upwards during times when demand for US government bonds is not very high. Now, the chart that you see on your screen right now represents the historical yield on a US government 10-year bond going all the way back to 1981. So this blue line basically represents the annual interest, the yield that you could have historically earned by investing in a US government 10-year bond. And the yellow line that you see on your screen right now represents the historical yield on a US government 3-month bond. So this is basically the annual interest or the yield that you could have earned historically by investing in a US government bond of 3-month duration. By the way, US government bonds of duration up to 1 year are usually not called bonds. They are usually referred to as bills. And that's why, as you can see on the screen right now, I've referred to the yellow line as US government 3-month bill, not US government 3-month bond. Now, the most important thing to note in this chart is that most of the times in the last 45 years, the blue line has been above the yellow line, which basically means that historically, the yield on a US government 10-year bond has most of the times been higher than the yield on a US government 3-month bill. And it's not an accident. There's a specific reason why it is so. The reason is that a government bond is essentially a loan to the government. And with any loan, the risk that the borrower will default, the borrower will not be able to return your money, this risk progressively keeps on increasing with the duration of the loan. The risk of the borrower, let's say, losing his job or not being in good health and therefore not being able to return your money, these kind of risks are significantly higher in case of a 10-year loan compared to a 3-month loan. In order to compensate for this higher risk of default, most lenders insist on a higher rate of interest in case of longer duration loans compared to shorter duration loans. And we can see the same phenomena playing out in this chart as well. Since a government bond is essentially a loan to the government, we can see in this chart that most of the times bond investors demand a higher rate of interest, a higher yield in case of a US government 10-year bond compared to a US government 3-month bill. By the way, in this chart, we can also see that there have been brief periods when the yellow line has gone above the blue line. In fact, we have had one instance of the yellow line going above the blue line play out very recently between 2022 and 2024. So these are very peculiar times. These are times when the yield on a 3-month US government bill is higher than the yield on a US government 10-year bond. And when this happens, when the yellow line goes above the blue line, this is when the yield curve is said to have inverted. Now, there is one more way to visualize the difference between the blue line and the yellow line. The red line that you see on your screen right now basically represents the difference between the blue line and the yellow line. So the red line basically represents the US government 10-year bond yield, which is the blue line, minus the yield on a US government 3-month bill, which is the yellow line. And since most of the time the blue line is above the yellow line, that's why the difference between the blue line and yellow line most of the times is a positive number. And that's why you can see the red line, which basically represents the difference between the blue line and the yellow line. Usually, most of the times, the red line is above 0. And during times when the yellow line goes above the blue line, these are times when the yield curve, as we just discussed, is said to have inverted. And during such times, the red line, which basically represents the difference between the blue line and the yellow line, this difference turns negative. And therefore, during times of yield curve inversion, this red line basically goes below 0. Why does the yield curve inversion matter? Well, a yield curve inversion matters because, as you can see on your screen right now, historically, whenever we have got a yield curve inversion, that has almost invariably been followed by a recession in the US. And why should you care about a recession in the US? Well, you must care about a recession in the US because, as we're going to see in just a while, a recession in the US invariably leads to very bad outcomes for equity markets, not just in the United States, but for equity markets around the world, including here in India. And it is in this context that we have to be doubly cautious right now, because we have got this massive yield curve inversion in the recent past between 2022 and 2024. So does that mean that we are going to get a recession in the US going forward in the near future? Well, in the world of finance, nothing is a given. In fact, if I have to be objective, I must also point out that there have been instances, very few instances, when the yield curve did invert, but that was not followed by a recession. For example, we did get a yield curve inversion in 1998. It was a very shallow inversion. As you can see on your screen right now, the red line barely went below 0 and then went up back again. But it was an inversion nevertheless, and this inversion was not followed by a recession. There have been only 2 such instances when the yield curve inverted, but it was not followed by a recession. The most recent instance is what you see on your screen right now, in 1998, and prior to this, we got another instance around 1966. That's why it's always possible that the most recent yield curve inversion that we have got between 2022 and 2024 may not be followed by a recession after all. But in my view, the possibility of that is really, really low. Because at least for me, what is coming out from this chart is that the probability of a recession ultimately materializing in the aftermath of a yield curve inversion is significantly higher than the odds of a recession not materializing after the yield curve has inverted. Now let's look at what has historically been the impact of a yield curve inversion in the US on equity markets here in India. So for that, we need to look at the yield curve, which is the red line, in conjunction with the NIFTY here in India. So there you have the red line basically is the US yield curve. That's the difference between US government 10-year bond yield and the yield on a US government 3-month bill. And the blue line that you see on the screen below the red line basically represents the NIFTY. In this chart, we can see that we got a pretty long inversion between somewhere around middle of 2006 and middle of 2007. And as expected, that was followed by a very, very severe recession in the US that started in January of 2008. And as soon as we got an onset of a recession in the US, that in turn paved the way for very severe downturn in equity markets around the world. Here in India, the NIFTY corrected by as much as 60% between January and October of 2008. The next time the yield curve inverted was in 2019. And once again, a couple of months later, the US economy slipped into a recession from January 2020 onwards. And as soon as the US economy slipped into a recession, just like in 2008, we got severe downturns in equity markets around the world. Here in India, the NIFTY corrected by as much as 38% in early 2020. Now let's take a closer look at the exact sequence of events that typically plays out in the run-up to a recession. And for that, let's take a closer look at the yield curve inversion that happened before the 2008 recession. As you can see in this chart, sometime towards the middle of 2006, is when the yield curve, the red line, went below zero. So this is basically when the yield curve inverted. And then sometime around the middle of 2007, the red line, the yield curve went back above zero once again. So this point, when the yield curve goes back above zero, this is the point where the yield curve is said to have uninverted. So we got the inversion in middle of 2006, and then we got the uninversion sometimes towards the middle of 2007, and then couple of months later, from January 2008 onwards, we got the onset of a recession in the US. So the point that I'm trying to highlight here is that it's not the inversion that we have to worry about. It's the uninversion of the yield curve that we have to focus on, because it's in the aftermath of the uninversion of the yield curve that we usually get the onset of a recession in the US. We got an exact repeat of this in 2019. Sometime towards the middle of 2019, the yield curve inverted. The red line went below zero. This inversion didn't last for a very long time. Sometimes towards the end of 2019, the yield curve had uninverted, which means the red line had gone back above zero. And as soon as we got the uninversion of the yield curve, within a couple of months after that, we got the onset of a recession in the US in January of 2020. And it is in this context that we have to be very, very cautious right now. And that is because of this massive inversion that we got in the yield curve between 2022 and 2024. As you can see, the yield curve inverted in October of 2022. Then the yield curve stayed inverted for more than 2 years. And finally, the uninversion came in on 13th of December 2024. So we basically got an inversion lasting 780 days. That's arguably the longest inversion in recorded history. I don't think we have got an inversion prior to this which has been longer than this. And the reason I'm highlighting the length of the most recent yield curve inversion that we have got is because prior to this, there have been only 3 instances of yield curve inversions lasting more than 500 days. And guess what? Each of these 3 yield curve inversions lasting more than 500 days were followed by some of the severest recessions in US history and were accompanied by equity market drawdowns that were amongst the worst in stock market history. Let's go through the details of these 3 inversions lasting more than 500 days. The first instance of a yield curve inversion of more than 500 days was in 1929. And we all know what happened after that. We got the Great Depression starting 1929. And what was the impact of the Great Depression on equity markets? Well, we didn't have the S&P 500 back then. We only had the Dow Jones. The Dow Jones corrected by a staggering 89% between 1929 and 1932. The next time we got an yield curve inversion lasting more than 500 days was between 1972 and 1973. And that in turn paved the way for a very, very severe recession starting late 1973, going well into 1974. And what was the impact of this on equity markets? Well, accompanying this recession, the S&P 500 witnessed a crash of as much as 48%. And finally, we got the third instance of a yield curve inversion lasting more than 500 days between middle of 2006 and middle of 2007. And we all know what happened after that. This inversion paved the way for a recession which started in January of 2008, which was arguably the worst recession in the US since the Great Depression of 1929. And the impact of this on equity markets? Well, during the course of the recession of 2008, the S&P 500 crashed by as much as 52%. So there you have it, my friends. We have had 3 instances of yield curve inversions lasting more than 500 days. And every single time, we got a very severe recession in the aftermath of the inversion. Not just that, each of these recessions were accompanied by stock market drawdowns ranging from 50% to almost 90%. And that's why, my dear friends, we have to be very, very cautious at this stage. Because what we have got in the very recent past is only the 4th instance of a yield curve inversion lasting more than 500 days. Now, not trying to scare anybody here, to be sure, we have only got 3 instances in the past of yield curve inversions lasting more than 500 days. And by no stretch of imagination can only 3 instances make for a statistically significant number of observations, which basically means that just because this has happened 3 times in the past does not necessarily mean that history is going to repeat the fourth time as well. But it goes without saying that we have to be very, very cautious at this stage, because if this table is anything to go by, then the probability of a very severe downturn, both in the US economy as well as in equity markets around the world, sometime in 2026, is not insignificant. Now, coming to the million-dollar question, which is how to position our investment portfolio at this stage, given everything that we discussed in this video. And my dear friends, the short answer is that for now, I'm fully invested in my personal investment portfolio as well as the investment portfolio of my clients. But my dear friends, this positioning is not permanent. We will start to cut equity exposure across our client portfolios as soon as we can detect that liquidity conditions in financial markets are starting to tighten. And my dear friends, while I will try my level best to offer timely warning to all of you, my dear viewers, as and when, in my view, liquidity conditions start to tighten, what goes without saying is at this stage, it's imperative that each one of us has a rules-based investment approach. And by a rules-based investment approach, I mean an investment framework linked to liquidity-related global macro parameters that can help us ride this ongoing rally till such time that liquidity conditions continue to remain easy, and also help us get out of equity markets in a timely manner before liquidity conditions start to tighten and pave the way for the next material drawdown in equity markets. At metacaps.ai, we have built a robust rules-based framework in order to drive our flagship AlphaSIP strategy, which is what we make use of in order to manage the portfolio of our clients who have entrusted their hard-earned money for us to manage. As part of the AlphaSIP strategy, we continuously rebalance our client portfolios between a bunch of high-performing equity funds and debt funds based on changes in not one, not two, not three, but more than 15 bond market as well as global macro parameters. Our rules-based approach has enabled us to execute a bunch of fantastic trades over the last 1 year, which has enabled our clients to sidestep to a very large extent the correction that has been witnessed in the NIFTY between September of 2024 and March of 2025, and also ride the rebound rally to a very large extent that has been witnessed in the NIFTY since early April 2025. And that's why if you are one of those who is finding it difficult to manage your investment portfolio based on a very strict rules-based approach, then you can consider investing in our flagship AlphaSIP strategy. We offer the AlphaSIP strategy in 3 different variants, the details of which are there on your screen right now. And the variant which happens to be most popular with retail investors is the first one, the AlphaSIP tax saver variant. In case of the AlphaSIP tax saver variant, as long as your total investment amount is within 2.5 lakh rupees per year, which translates to about 20,500 rupees per month, and you continue with your SIP investments for a period of at least 5 years, the entire maturity proceeds can potentially be tax-free under Section 1010D. In fact, the AlphaSIP tax saver variant is arguably amongst the very few investment options left, if not the only investment option left, where the maturity proceeds are completely tax-free, even under the new income tax regime. If you're interested in any of the 3 variants of the AlphaSIP strategy, then please go to our website metacaps.ai/products and register for the variant that suits your requirement the best, and somebody from our sales team will get back to you to take the discussion forward. Ladies and gentlemen, that's it for now. This brings me to the end of this video. I sincerely hope that you liked the insights that I shared during the course of this video. If you did, then please do like and share this video, and please do consider subscribing to my channel. Thank you for taking time to watch this video, and goodbye till we meet again in the next video.